Good morning, folks, and welcome to another one of my videos. I have one pair on watch today, just one pair, and that is euro dollar. I have, for the time being, just parked West Texas Oil on the sidelines, and I'm just going to touch on why that actually is, because it's important to understand the thought process. It's important to understand your own thought process and to have a consistent thought process when you're trading. So one of the reasons I have parked this on the sidelines, if we just analyze the lower time frame structure, this could be a kind of head and shoulders pattern to push lower. We could be seeing something like this. Now, one of the things, if it was a head and shoulders pattern, it would probably have the same, a similar depth. This flag would have a similar depth to the one on the right, to the one on the left rather. And if you look at, bearing in mind this is a daily forecast, if you just look at the time at the bottom of the screen, that wouldn't be ready by the end of the day. It could also be if we just try that again, it could also be a larger bull flag to push higher. Now, remember me saying that if I was looking to get long on this, I would be looking for some kind of 4-hour structure, which would look a little bit more like this. This is, if I just flip this upside down, this is what we call a falcon flag, where we have this larger flag, and in the corner we have a tighter flag like that. It could do that. Okay, now if it was to do that, as you can see once again from the times at the bottom of the screen, that would not be ready by the end of the day. Okay, the other alternative, given that we've pushed a little bit higher, and this is important, if we were to push, bearing in mind we were down in this area yesterday, if we were to push below this ray line, which is what I'd be looking, if I was going to look to get short, and I was looking for the same kind of flag as I was looking for in my previous forecasts, then this flag would be disproportionate in size relative to the length of the impulse down which has preceded it. Okay, now that's important because generally this would be a high risk trade, because generally speaking, in my experience, the flag will be kind of, of a 30, there would be kind of a 30% pullback at least of the impulse down which preceded it. Now, if that was to happen, we would have something more in the region of something like this. Okay, and once again, that would not be ready by the end of the day. So even if I was looking for what I was looking for yesterday, I'm still thinking about the proportions. And obviously, for this to crash to the downside and end up below here, I don't want to be taking just a tiny little tight flag, which then turns into a larger version of itself. So these are all things that I'm factoring in when I'm placing my trade, looking at when I'm coming up with my forecasts. You can see we have a tiny little flag here, and of course, if we were to pop lower, we may get another one. I'm looking at I'm thinking about the sequence as well. Okay, so we may get something like that, and then they start to get slightly larger, and again, that would not be ready by the end of the day. I have a little alert placed just above that ray line to see if we push down to that area, but again, I'm just going to let this this pair do its thing and see what it wants to do. And I'm not going to try and force anything, and that's what we try and do as traders. One of the reasons people lose money is because they stick to a bias. Perhaps they've seen, a pair such as West Texas Oil. They've been looking at it for a while. They've been waiting patiently down in this area for it to come up to this area, and then as soon as it does, all their rules and strategies and plans and neutral thinking go out the window, and then they start jumping into trades. And the important thing to do is to stay neutral, and then you don't blindside yourself to all the possibilities that the market could evolve, that price could evolve into. So just a little mini lesson there on West Texas Oil. I'm just going to let that do its thing. Onto the watch list, and that is euro dollar is looking the most likely to shape up for a potential trade, in my opinion. The other trades look like they need more development, so I'm just going to once again just let them do their thing. So why am I looking at euro dollar? I am looking at euro dollar because on the higher time frames, and I say higher time frames, I mean the weekly chart, we have this 1, 2, 3 touch structure with equal spacing, which taps into this area of liquidity where there was an exchange of liquidity last time around. The last line in the sand, the last one that I can see out of all of this price action, we tap into that. We have this 1, 2, 3. We tap all the orders there. There was likely a lot of profit, a good area for profit taking. If there's no, you got to think about this logically. If there's no other notable inflection points, this is a good area for people to take profit. Okay, and of course, if we take profit in that area and there's an exchange of liquidity, it's likely where price will reverse to the upside. So price does reverse to the upside, and it taps into. We push up aggressively, then we start to see a slowdown in momentum, and then we get this aggressive push down, which narrowly misses this liquidity point where there was a big sell-off last time around. What does that tell me? That tells me that if price moved up to this area and it sold off aggressively, there's likely a lot of orders in this area. And what we typically see is price come close to an area of liquidity and then sell off and then find its way back up there. I've talked about this. This is what we call a near miss. So we near missed to this area of liquidity, and then we sold off. We came up a little bit closer. We near missed again. Okay, this is what I call the FOMO channel. People trying to sell this whilst there's still a lot of orders in this area causes this kind of pendulum effect, which means that price doesn't have the enough momentum to break to the downside. It breaks back up again. Okay, and then we tap out all the orders here, and then price moves down aggressively. Okay, so not looking at this on the higher degree, this is kind of a shorter term move. We have this 1, 2, 3, this 1, 2, 3 wave move, which taps into this area here, just looking for a sell off, a potential sell off down to this area to fill this near miss to take out this low. And the reason I haven't got my arrow pointed any lower is because we've already tapped into this area, so there's no reason for price to come back down to this area. Okay, so this is more on the higher degree a shorter term move. You can see that we had a big sell off here. On the daily chart, you can see one of the clues for me that we would likely tap into this area and reverse, aside from the fact that we had this 1, 2, 3 touch move, which near missed this area, this piece of structure here, is the fact that we have this 1, 2, 3 last leg. Okay, that's a very big clue. This is a very intentional move, which gives me a clue that we would likely break above, catch people the wrong side of the market. Some people start buying because they believe that what was previously resistance now becomes support because it's broken above, and in the majority of cases we find that not to be the case, those of us who trade the Falcon strategy. So this is me. You'll see this more clearly on the lower time frames when I drop down. But this is just me pattern separating, trying to make sense of where one structure begins and where one structure ends and another one begins. So if we were to just do that now, so you can see the next thing. So we're positioned well. We're positioned well in the sense that we have this 1, 2, 3. We've broken to the downside, and even if you wanted to extend this, I've just reined that in because this is now a completed piece of structure. But even if you wanted to, extend that, we're now trading below that for that potential move to the downside. So we're positioned nicely. Price is positioned nicely. So the next thing I'm looking at is what does the sequence look like? Okay, now this is a bit of a corrective wave. When we have corrections which form not below each other but kind of through each other, this is more of what we call a corrective wave, okay, which may imply that we will likely, when you see a corrective wave, this is potentially a middle section to push higher, okay? But we shall see where there's a lot of profit potential to the downside in the meantime that can be made before we even have to assess that. But we have this push down, tighter flag. This is a prime example of what I was talking about with West Texas Oil. Okay, if we get a big move down like that, the corrections are usually proportionate. That kind of 30% pullback. So if we take the pullback, the Fibonacci tool from there, this is exactly what I was talking about. Look, the pullback before this moved lower is 30%. Okay, it's not a mathematical. It's not mathematically precise, but generally speaking, a 30 to a 50% pullback on a non-corrective pair such as euro dollar is a healthy pullback before price continues. So we get this tighter consolidation into this larger consolidation. Whoops, I didn't mean to do that. Then we get an impulse down, correction, impulse, larger correction tighter correction. We typically see these tighter corrections, as I've said, either within or on the break of these larger corrections when price is going to break to the downside, because the volume has been built up in the larger correction, so therefore price doesn't need to correct for as long within these tighter corrections before it pushes to the downside. We have another structure here into a larger structure, another example of that, tighter structure, then we break to the downside. Now, one of the reasons I'm interested in this area here is because we can potentially, we've pushed to the downside, price didn't find liquidity from here, and we could potentially be playing all of this volume that was built up here. We could potentially capitalize on that for a move to the downside, okay, as people bail out of this position that we're trading within here. So what would that look like? Once again, so we're positioned nicely, but once again, I'm asking myself, the proportions of the flag. Now, here's a prime example where, you could get short here. So we take this impulse down from here. You could get short. We have this kind of flag here, but, is that proportionate? Is that proportionate to the impulse down which has preceded it? I would argue not, okay? So I'm looking for something which is proportionate, and I wouldn't expect, I wasn't expecting this pair, this correction to just suddenly break to the downside during the Asian session, which is why I forecasted the following. So we have this, okay? And you might think, well, why has he forecasted it like that, right? So we have this little inflection point here. And sometimes what you can do, if you drill down to the 15-minute chart, you can see price for what it is. So if I drill down to the 5-minute chart, what you can see here is that we have a little tight consolidation here. We have a tight consolidation there, and then price breaks to the downside. And then we have another correction. But the important thing is that this correction formed below here. So I'm seeing this as a separate piece of structure to the rest of it, because if you look here, price scooped up above this low, which gives me a clue that this is all one piece of structure and that this is a separate piece of its structure, particularly when the high of that structure forms above this low here, okay? So price is less likely to gravitate towards this high because it formed above that ray line which I just showed you, and because this appears to be one structure of its own because it formed below there, okay? So with that in mind, what I forecasted after I'd analyzed that was the following. And the reason being is because we have this sharp hook point here, and what that can often act as is the first touch within a potential 1, 2, 3. So just looking for price to come back up to here, we would likely get a near miss, the FOMO channel as I call it, which would likely fall just shy of this area of value. We would likely then push down, and we'd see that kind of corrective move down, because some people are trying to sell this whilst there are still orders up here, and whilst people are placing orders up here, limit orders, and then we would likely see that move to the downside. Now, if you look at the time at the bottom of the screen, this may not be ready by the end of the day, but I've just kept it on watch anyway, just in case. And if it doesn't shape up, then so be it. But we would likely have that 1, 2, 3 then, and we would tap it. If we tapped into this area, if you look at my stop loss there, 17 pip stop loss, I would still be protected even if price did trickle up to retest the back end of this structure here, which it could possibly do, and it could possibly tap into this area of consolidation there. But even if that was to happen, I would still be protected to a large extent, because I would have my stop loss just above there, just for extra protection. It's not about getting the tightest stop loss. Many people try to do that in trading that, have a good idea what they're doing, and if they just weren't quite so greedy with their stop losses when it was appropriate not to be, they would actually be more profitable. What greed is, without question, one of the biggest reasons why people fail. So there's no need to, we're not trying to catch home runs every trade. All we're trying to do is milk the profit available and then move on to the next trade. You can always think to yourself, oh, I could have made an extra 2, 3, 4, 5% there. Don't worry about that. If you're in this for the long run, just milk the trade when the trade is offering profit potential and then move on. So that's what I'm going to be looking for today, folks. If we do not push up to this area, which we may not by the end of the day, then I'll not be looking to place a trade on this pair. But hopefully you've learned something. And just to touch on it again, this would be, if we took the impulse down from there, we would have a pullback, which is something in the, just over 50%. I mean, if you wanted to take it from there, you are talking about a pullback, which is almost exactly 50%. So, and then of course we would be looking for that higher time frame. There is literally nothing in the way until this inflection point there, where there may be quite a bit of profit taking. But even if we put, if we push down to there, let's just try and, where are we? Let's just try and get that auto scale off. Even down to that area there, we'd be, you're talking 7%, potential 7% profit, even down to there, even with that slightly wider stop loss to account for, price being, your stop loss being sat above there. But that's what I'm going to be looking for today, folks. I hope you've learned something, and I will be back tomorrow with another one of these videos if I have a pair or more than one pair on watch. Have a great day.